And a very warm welcome to you all for joining us today, today's webinar, a golden contribution to pension fund portfolios, which we are holding together with our education partner, the World Gold Council. My name is Helen Lamb, and I'm part of the membership team at the PLSA, looking after our members' needs and ensuring there are opportunities for learning and access to helpful content. We are so pleased to have this opportunity to focus on a subject that is gaining traction in the industry. We know that gold is known as a safe haven asset, and it's been overlooked by pension funds because it does not pay a coupon or dividend. It is, however, multifaceted and provides an attractive option when looking for portfolio diversifiers. So our webinar today will give a clear picture of its versatility as an investment and where it can fit within a pension fund portfolio. The World Gold Council is a market development organization for the gold industry. Its role is to stimulate and sustain demand for gold, provide industry leadership, and be the global market authority. It is a membership organization comprising more than 30 of the world's leading gold mining companies. A large part of its role is to promote gold as a mainstream asset class by enhancing institutional and retail investors' understanding of gold as part of a balanced portfolio. And with their mandate to educate and share market knowledge, I'm pleased to tell you that there will be another opportunity for discussion at the PLSA's investment conference next month, in the form of a roundtable session. This builds on the Gold Investment Made Simple guide we launched with the World Gold Council at last year's investment conference. So as you can hear, there is a lot of opportunity to develop your knowledge. We're joined today by John Reade, who is Chief Market Strategist at the World Gold Council. He has more than 30 years' experience in the gold industry and related fields, and has been a gold strategist for hedge funds and investment banks, and has worked down mines and on gold mining projects. John is one of the world's foremost authorities on gold investment and leads a global dialogue by engaging with fund members and investors. Joining John is Claire Lincoln, who is Head of Sales EMEA at the World Gold Council and manages distribution relationships across Europe. Claire has experience working in sales roles within financial services firms, including Bloomberg, Credit Suisse, and the Bank of New York Mellon in London. We are certainly in a safe pair of hands for today's discussion. Claire will set the scene about global demand and usage and the scale and depth of the gold market and the attributes of this quality, high liquid asset. John will present an overview on the gold demand trends during 2020 and will also give a market outlook for 2021. And they've built in lots of time for your questions. Can we see the first poll, please? What percentage of your portfolio is currently allocated to gold? 0, 1.2%, 2.4%, 4.5%, or more than 5%. It is looking like we have a very clear group of people here today. Most of our viewers have 0% of their portfolio allocated to gold, with 7% 1 to 2% and 7% 2 to 4%. So I think that will give John and Claire a very good indication. So over to you, Claire and John. I'm going to leave you now, and I'll be back to help with questions. Claire, if you can start off, please.
Perfect. Thank you very much, Helen. Just checking that you can hear me loud and clear.
Yes.
Lovely. So thank you, and a warm welcome to everybody joining us today. And thank you, Helen, for that great introduction. Just a very quick recap. My name is Claire Lincoln, and I head up distribution relationships for the World Gold Council out of the EMEA region. Today, I'm sharing the virtual stage with my colleague, John Reade. He really is our in-house gold guru. So if there is something that you want to know about the gold market, it is highly likely that John is going to know the answer. As Helen has already alluded to, we are the World Gold Council. We were established over 30 years ago, and we are recognised as the global authority on the gold market. And a large part of mine and John's focus is to help investors explore and understand gold's attributes and what drives its demand. Okay, so we can go to the next slide, please, from this one. That's great, thank you. So at the World Gold Council, what do? We publish a wealth of data, thought-leading research and insights on the gold market. And all of this is publicly available to you through our website, goldhub.com. So if you just flip to the next slide, please, that would be great. And all you've got to do to gain access here to our online portal is simply register your name and your email address. And hopefully there'll be lots of useful nuggets of information there for you. Okay, so let's get things started. So gold, of course, has many identities and serves different purposes. As Helen's already said, most commonly it is recognized as a safe haven, a hedge against inflation, and a way to preserve wealth. But at the same time, some investors only think about gold as a tactical asset and no different from other commodities. Therefore, our aim over the next 25 minutes or so is to bring some clarity to a sometimes misunderstood and overlooked asset class. And with a bit of luck, by the time we finish today's webinar, you should have a clearer picture on gold overall and the role it can play in a portfolio. If you can move to the next slide, please. So let's start at the very beginning and look at what gold really is. And the answer here is that gold is unique. We refer to gold having a dual nature, given that it is both an investment product and a consumer good. In this slide, we are showcasing gold's average annual net demand over the last 10 years, which stands at around 3,100 tonnes. When we speak about global gold demand, we tend to divide it into the 4 categories that you see on the screen now. The left-hand side shows us that more than 40% of global gold demand, in fact, comes from jewellery and technology combined. Investment demand makes up a further 42%, with central banks making up the remaining 17%. So the simple message really to take away from this first slide is that gold has many applications in its usage. Next slide, please. So that's why gold is unique. And now it's time for us to review the core characteristics of gold, and I'm going to take you through these one by one. So firstly, returns. Historically, and yet often, to many people's surprise, in fact, gold has generated long-term positive returns. If we're looking back 20 years, as shown in this first chart, gold's average annual returns in sterling have been around 12%. And more recently, just under 10% when looking back 5 years. In fact, for all 3 periods captured in these charts, gold's average annual returns have been comparable to many other equitable markets. The returns element of gold can, at times, though, be overlooked, as sometimes the focus of attention is more on the fact that gold is a non-yielding asset, which of course is true. But gold doesn't pay a coupon or a dividend because it doesn't bear any credit risk. Gold is no one's liability. However, as clearly shown here, gold can offer a means of long-term returns. Next slide, please. So now let's take a look at gold's liquidity profile. The gold market is global, it's large, and it is highly liquid. And I think that this slide does a really good job of putting that statement into context. Gold's liquidity tends to exceed more than 100 billion sterling a day, which is comparable to some major currency pairs such as euro sterling, and actually higher than some debt markets such as UK gilts. If we convert these numbers into dollar terms and we hone in on last year, just as an example, we saw gold's average trading volumes increase to around $180 billion a day, which was an uptick from about $145 billion a day in 2019. So the point to really take away here is that gold is a high quality liquid asset. Next slide, please. So moving on, this is attribute number 3, and that's gold's role as an effective portfolio diversifier. What this slide is aiming to showcase is gold's correlation profile relative to other markets, such as the broader commodities complex. The red bar here represents commodities via the BCom index, and as you can see, it has a positive correlation with the FTSE overall. So breaking this down, what we're showing here is that commodities tend to have a positive correlation when the FTSE is up by more than 2 standard deviations, but also when it falls. Gold, in contrast, it has a positive correlation when the index is rising, but crucially, a negative correlation when the index falls. Now, most investors will agree the importance on diversification, yet sometimes effective diversifiers can be hard to find. Many fail to protect portfolios when investors need it most. Gold, however, does what it says on the tin. Next slide, please. So what happens when we combine gold's long-term returns, liquidity, and diversification all together? What are going to be the benefits to you, the investor? Here we are showcasing an average pension fund based on a Willis Towers Watson global pension study. And we're showing it without an allocation to gold, a 5% allocation, and a 10% allocation. And this base case is clearly demonstrating that by adding gold, a portfolio's risk-adjusted returns can be enhanced. And it's for this reason that we believe there is a compelling case for all portfolios to hold an allocation to gold. So before I hand over to John for the second part of our presentation, I think it's time for our second polling cue. So question 2, have you changed your gold allocation over the last 12 months? NA, not applicable, no change, decrease slightly, increase significantly. So I'll just give that a couple of seconds for everybody to submit their answers. So it looks like again, majority is either not allocated or been no change in allocation. So that again is really useful. We can perhaps come back to that slightly afterwards. So with that, John, I'm going to pass the mic over to you.
Apologies for the jumper. It's relatively cold in my home study. Next slide, please. Here we go. That's perfect. So I'm going to talk about gold performance in 2020 and touch upon the outlook. I think the most important thing I would say about 2020 in gold is that it performed very well. Up about 25% in US dollar terms, relatively small drawdown as well. For a long time through the course of the year, it was the best performing major asset class, but as we saw, the NASDAQ power ahead towards the end of the year was overtaken by the tech stocks. But in a year where we saw big drawdowns, lots of volatility, and outright weakness in the case of some assets, including commodities, high yield, etc., gold performed well and demonstrated its value in a portfolio during a year of turmoil. Next slide, please. Now, turning to the fundamentals of gold demand, it may seem paradoxical that gold demand fell to an 11-year low, yet that price went to an all-time high. There's a couple of reasons for that. The first of which is that it wasn't only demand that was affected by the coronavirus pandemic, supply was as well. So total supply to the market was down about 4% on the year. For the second year in a row, actually, we saw mine supply down, which is the first time since 1975 that we've had back-to-back falls in mine supply. I guess the other major factor, however, though, is a lot of the investment in gold takes place in the over-the-counter market. People buying bilateral exposure to gold from investment banks typically, and in some cases actually withdrawing that gold from the investment bank and vaulting it themselves. As a consequence of that entire component of the market is completely opaque, even to people like ourselves that spend all day, every day looking at the gold market. So such a decline is characteristic of new highs in the price because investors generally drive the price higher. Now, we did see some elements of investment being reported last year, of course. Exchange traded funds saw very strong inflows, record inflows of nearly 900 tons, and even a small increase from the on the retail investment in physical bars and coins, which was up 3%. But we saw very weak jewelry demand, and central banks who've bought gold for every year for the last 10 years bought quite a lot less in 2020. Next slide, please. So this is the chart that shows inflows and occasional outflows into the gold-backed ETFs, both in tonnage terms, but also demonstrating the change in AUM as well. And what you can see here is that most years we've seen inflows into ETFs. They've accelerated during crisis time, so look back at 2009. And then, of course, in 2020 as well. We have seen outflows as well, particularly when the gold price corrected in 2013. There was quite a lot of money that left the space in a relatively short space of time, but that's a consequence in a way of gold's liquidity. So very strong inflows in 2020. The first 10 months of the year saw consistent buying. And it was only after the very good news that we got about vaccines that was released in November did we see a substantial outflow, and December a more modest outflow. Inflows have started the year on a small positive basis in January, and so far month to date they're about flat. So far not the same impetus towards investment in gold that we saw in 2020, but the signs are certainly that modestly positive so far. Next slide, please. Now, I noted that retail investment in physical bars and coins did increase a bit last year, up 3%. To be honest, this would be less than you'd normally expect when you're seeing an investment-led increase in the gold price. But one of the reasons for that is that it was a year of two halves. Western markets, such as the US, many countries in Western Europe, saw very good demand for bars and coins. Emerging markets, however, did not. And I think the reason for that is that much of their economies were locked down, certainly in the first half of the year. And there's obviously been a big income effect and wealth effect from the consequences of the coronavirus pandemic and its lockdowns associated with it. So strong developed markets, weaker emerging markets, very much the theme in terms of physical bar and coin buying. Next slide, please. But it's in jewelry demand that you really saw the weakness come through, and the principal reason for that is the fact that more than 2/3 of jewelry demand normally takes place in emerging markets, with particularly China and India the largest contributors to jewelry demand. Those economies were hit particularly hard by the coronavirus, and people were kept away from the opportunity to buy gold. Certainly for much of the first half of the year, and we saw improvements through the second half of 2020, which we expect to continue into this year as well. Next slide, please. Central banks have bought gold every year for the last 11 years. They've been a major contributor, I think, to the demand side of the supply and demand equation, but also are important in terms of determining sentiment towards gold. It hasn't always been the case. In the 20-odd years before 2010, central banks sold a lot of gold. European central banks, which had ended up with a lot of gold at the end of the gold standard, were selling pretty consistently through the 1990s. And for those of you old enough to remember, you may remember that the UK sold about 60% of its gold reserves at an average price of about $270 an ounce in the early 2000s, and as we like to say in the trade, thanks very much, Mr. Brown. That's changed around now. Developed market central banks recognized through the financial crisis that gold was something that they wanted to hold on to because there was a limited amount of high quality assets that they could buy. AAA rated sovereigns were being downgraded left, right, and center. And of course, interest rates fell tremendously. They also did a lot of work looking at how gold had helped their portfolios during the global financial crisis and realized that it's actually a good thing to have. So developed market central banks stopped selling gold. At the same time, emerging market central banks, which had amassed vast foreign exchange reserves since the EM crisis of the 90s, didn't have much gold in their portfolios. They didn't have thousands of tons of gold at the end of the gold standard because their reserves were tiny then in dollar terms. So what they've started to do is to increase slowly and steadily their holdings of gold, because of the diversification benefits and for some other factors as well, potentially to do with a move away from the dollar as the only reserve currency of the world. Now in 2020, we saw net buying by central banks, but it did slow. And it slowed for a couple of reasons. One of the major buyers of gold, in fact, the biggest buyer of gold over the last 15 years has been Russia, which took a decision in the mid-2000s to increase the holdings of gold that it had, and initially targeting 10% of their foreign exchange reserves. By the time we got to 2020, that was more than 20%, and they probably quite sensibly decided that that was a decent amount of gold to have in their central bank portfolio. So they announced that they were going to stop. Similarly, we've seen a couple of other central banks look at the proportion of gold that they had in their reserves following the sharp increase last year, and also declines that were taking place in their foreign exchange reserves, and realize that the proportion of gold that they had there was probably a bit much. So they trimmed for asset allocation, strategic reasons. The final sellers were principally countries that buy gold from their domestic gold mines. So there's a number of countries, particularly in the Eurasian region, so Kazakhstan, Kyrgyzstan, Tajikistan, etc., that routinely buy gold from the domestic producers and then opportunistically sell that into the market when they think the price is high. So we saw a number of those sales last year. And then finally, Turkey, which is the biggest buyer that we saw last year through the course of the year, saw some declines taking place in the second half of the year. Not explicitly because they wanted to reduce their reserves, but one of the ways that Turkey acts in the gold market domestically is the Central Bank of Turkey makes available its liquidity to the commercial banks there. So when you see very strong retail demand for gold, that causes the commercial banks to pull gold from the Central Bank of Turkey. So we don't think that they're going to stop buying as a central bank, but when you do see very strong retail demand, you may see month-on-month declines in holdings by the Central Bank of Turkey. Now, overall, we're very confident that we'll see central bank buying continue in the future. We think it's more likely that we'll see purchases in the same sort of order of magnitude as we saw in 2020, rather than the record-breaking years of 2018 and 2019. But there is the potential for upsides here. One of the things that one of the teams at the World Gold Council does is engage with central banks. We have relationships with more than 98% of the world central banks. And I would say that over the last few years, the clamor of interest from central banks has been increasing every year. So just because we've seen a slowdown take place in 2020, I don't think that that means that gold has gone out of favor with central banks. And I would expect to see more central banks buying in the future than we have potentially in the past. Although what that translates to in tonnage terms is hard to say. Next slide, please. So what are we expecting for 2021? And I've given some indications of some of the major components of supply and demand in the last few slides, but I'll go into those in more detail on the next slide, please, Jim. So we think that the investment-led gold market of 2020 will be largely repeated in 2021. We're going to see a higher allocation to risk assets by many investors. And what that's typically led to is, certainly amongst some investors, is as they add risk, they add more diversification as well. And that's translated many times into higher gold allocations. The second thing that's likely to drive investment demand for gold is the concerns about the extraordinary fiscal and monetary policy response that's taken place to the coronavirus pandemic. That sort of concern triggered a lot of buying in gold during the global financial crisis, 2009, 2010, 2011 in particular. And we'd expect that sort of buying to be present in the market in 2021 and potentially beyond. Now, inflation is a hot topic, particularly as economies come out of a recession. And we're already beginning to see a lot of comments about inflation. Now, most of this is what you would expect to see from a recovery from a deep recession. But there are some concerns that we may be in for a period of higher inflation over the next few years than we've experienced maybe over the last 10 or 15. And any inflationary pressures tends to lead to investment in gold. Finally, I'd say we've seen some pretty sharp bounce backs in valuations in many markets, particularly some elements of the US equity market. And if we were to get decent sized corrections there, which we probably will at some point in 2021, that could spur some more investment for gold for its safe haven nature. Next slide, please. Looking at supply and demand dynamics, I've mentioned investment. We think this will be supported in 2021. The consumer side, though, will probably pull a bit harder than it did in 2020. The sharp declines we saw in jewelry demand, but also the industrial demand for gold, were showing clear signs of sequential recovery in the third and the fourth quarters. And anecdotal evidence from our teams around the world suggests that that's continued into the first quarter of 2021. I think it'll take until at least the end of 2021 for us to get back to normal, and normal will be affected by the level of the gold price. If the gold price is much higher than it was, say, in 2019, then the tonnage that's bought by consumers for gold will have or will be impacted by that. But I suspect that the effects of the coronavirus pandemic will be largely passed by the end of the year. Some of my colleagues in India, for example, think that I'm too pessimistic and it will be sooner than that. I've spoken about central banks. We expect to see net purchases continue, but at the slightly reduced rates. Excuse me. And then finally, on the supply side, which I haven't spoken too much about, we'll probably see a bounce back in mine supply this year. So it's very unlikely we're going to see 3 years in a row of declines in gold supply. Whether it gets back to the levels that we saw in 2019 is hard to say. There were some other factors that played a role in the declines in production in 2020. I personally think we'll see more of a bounce back to levels that we saw in 2019 or 2018 even. But there are questions about medium to longer term mine supply, particularly because there's not that many new gold mines and projects under construction at the moment. And there is a concern that the gold mining industry may struggle to maintain output at current levels. Next slide, please. So before I head into the Q&A, we have another polling question. If you could chuck that up for me there, John. So we've seen quite clearly that gold doesn't feature in your asset allocation strategy, certainly for most of the audience. Are you thinking about adding a component of gold to your portfolio? Is that true or false? And the answer's interesting. So from a base that has very little allocation to gold, we're seeing 35, 40%, whatever that math works out to be, considering an allocation to gold. Well, that's really interesting and very positive. Some people are disappointed when they go into a presentation and see that very few people hold gold, but to me that's great because it means we're not preaching to the converted. What I would say is, as Claire introduced in the beginning, we have a ton of research and data on gold on our website, and we would encourage you to make use of it. As I say, it's free to use, registration required only. You can also reach out to us directly as well for any more questions that you have on the gold market. I've spent getting on for 35 years in this market in one form or another, so I'm an extremely boring dinner party guest, but I do know quite a lot about gold. Right, so now we're going to move to the Q&A, and Claire is going to ask me some questions, and this is your opportunity as well to pick our brains on this subject.
Yep, absolutely. Thank you, John. So one area that I wanted to talk to you about, which we haven't covered yet, because we've looked at the attributes of gold, we've talked about the drivers, we've looked at what's happened last year. Sometimes in the conversations that we have with investors, we're asked about valuing gold, and it does appear that at times people struggle to value gold. Would you be able to go into a bit of detail as to why you think that is, and what solutions are out there?
I mean, it's a thorny question, and one that's really been a feature of many conversations over my career speaking to investors. Gold doesn't fit into standard valuation models because you can't do a DCF on it. It doesn't pay a dividend or a coupon, and there's little familiarity about an anchor to value gold. I mean, people generally know if the market's on a prospective 20 or 25 PE, it's expensive, and if it's on a prospective 8 PE, you want to buy loads of it. And similarly, we all have views about where interest rates are and where they're going, and whether they represent high interest rates or low interest rates. But there's no sense of feeling with that about gold amongst the normal investor. Part of it is what I think is due to unfamiliarity of the gold market. From the outside, it looks a bit weird. I mean, I've been whittering on about elements of supply and demand and what's going to happen to mine production and jewelry demand in India. And it all looks a bit strange compared to people that look at companies or fixed income markets. There's also a lot of nonsense written about it as well. It does seem to attract some quite interesting views, shall we say, particularly on the internet. They quite like arguing with me on Twitter if you're interested in having a laugh sometime. So what we've tried to do here, we tried to address this in a systematic investment professional perspective, providing loads of data, explanation, commentary, one-on-one meetings, discussions, so that people can become familiar with the real drivers of the gold market, what happens there, what they should be using to think about allocations to gold. And look, we're not the be all and end all on the gold market, but certainly I think it's I think it's a great source of information to help professional investors make decisions about gold.
And when people are considering or assessing the long-term return or performance of gold, John, are the supply and demand fundamentals of gold important? Because I think a lot of people tend to focus more on the short term, like the macro drivers, so the role of the dollar and rates. What would be your comments on that?
When I was a strategist sitting at a hedge fund, I didn't pay that much attention to supply and demand fundamentals because I was looking for where gold would go next month, 3 months, maybe 12-month view. And if you're looking at gold from a very short-term perspective, you only really need to look at macroeconomic drivers. Where's the dollar going? What's going to happen to real rates? Or what my quantitative colleagues would call a parsimonious, a very simple model of gold. And for investors that are tactical, that's probably enough. You can add bits and pieces that will help you, which professionals have developed to do that. But you don't need to pay too much attention to long-term factors of supply and demand. But if you're thinking about an asset allocation decision for a strategic allocation to gold, then a lot of those short-term drivers tend to disappear when you're looking for long-term returns. And the long-term drivers of returns that we've isolated and written about very much come from the factors affecting supply and demand. And the principal one is economic growth. Such a large component of gold demand is driven by things that are sensitive to economic growth, particularly on the consumer side, but also some aspects of investment because of the regular contractual nature of savings. So what we've done is we've put all of this together, a combination of the shorter term factors together with the long term factors into a whole valuation framework. We've launched this over the last few years and then have developed a tool called Quorum, which helps explain that both gold's performance, but also its long-term returns, and even giving a pretty decent view of what should happen to gold on a yearly basis over the next few years.
Perfect. Thanks a lot for that, John. Helen, back over to you.
So the first question is from an anonymous attendee. What are the different ways you can buy gold and where are the markets?
Sure. Well, that's an interesting question. The markets are everywhere. No, not quite. the principal market for gold is in the over-the-counter market, which is centered around London, but trades pretty much everywhere. So investment banks sitting in London, sitting in New York, sitting in various centers in Asia, trading gold with each other. So if I was an institutional client and wanted to buy some gold, I'd set up a metal account with an investment bank and then give my orders to them. Now that's quite specialized, and to be frank, not many institutional investors go down that route. And there are many other ways of accessing the gold market. The futures market's the second biggest component, and there's a large futures market in New York called the COMEX, part of the CME. And then there's other futures markets in Tokyo on Tocom and in Shanghai. Increasingly, the futures market there is becoming more and more important. But again, not everybody wants to buy futures. So the principal way that we see institutional investors buying gold is via exchange traded funds. These were launched in the early 2000s by the World Gold Council. And they're listed products on stock markets around the world. The biggest is in the US, but they're in pretty much every developed market now as either primary or secondary listings of some of the other products. And the way that these work is that ETFs give you the return of gold, less a small fee, by you're investing in a trust effectively that the only assets the trust has is gold, which is physically owned, vaulted, usually in London and a few other locations, that can't be lent out and can't be encumbered. So it's nearly as good as buying physical gold, but it's much more accessible. So that's the way that most institutional investors buy gold. You can buy physical bars and coins as well. That was a component of demand, and a large component of demand. That's typically more retail. I do know some institutional investors that own large stocks of the big 12.5 kilo or 400 ounce London Good Delivery bars. I call them the James Bond bars because we've all seen the film Goldfinger. So there are institutions that own some of those and have them vaulted, but again, it's a bit specialist. So the development of the exchange traded funds was really interesting in terms of opening up investment, democratizing gold investment, both to retail investors but also institutions. And that's typically the way that institutional investors and many retail investors access the gold market.
Thank you. Another question: where does gold fit with regard to the current focus on ESG, particularly in relation to the supply of gold, i.e. mining?
Cool.
Sure.
John, I can give a stab at that if you'd like.
Yeah, go for it.
So yes, it's a good question, and it's a question that is coming up, more and more. ESG considerations for investors and consumers, I think, and to that effect, many purchasers and investors in gold are really keen to understand more about the production process, so that they have confidence that the gold that they're buying has been, responsibly sourced. And it's worth kind of introducing something that we launched back in 2019. These are called our responsible gold mining principles, and they have been embraced by all World Gold Council member firms with a commitment to implementing these towards the end of 2022. And really, they were designed as a framework to set out clear expectations as to what constitutes responsible gold mining. And we've worked really closely with the members to develop the principles. And we believe that they kind of address, the key ESG issues when it comes to the gold mining sector across a variety of different areas. And, a requirement part of those principles is conformance, which will be externally validated and then require, public disclosure and independent assurance. So that's just giving one example of what is actually happening within the gold mining sector when it comes to ESG.
Thank you, Claire.
And if I could add a couple of things to that. It's not to say that the mines aren't performing well on an ESG basis already. I mean, even when I was in the industry in the 80s, it was still a large component of our job. I think the key thing about the responsible gold mining principles, it's bringing comparisons across the industry all in line, and it's certifying in one place that the industry can follow. It's not only limited to our members. We're about 60% of large-scale gold mine production. Our members of the World Gold Council, a number that increases all the time. We've had lots of new members join in the last couple of years, principally actually because of the work we've been doing on ESG, because the industry really recognizes that this is such an important topic. I can't go into meetings now, particularly in Europe, but increasingly around the world, unless we can talk about the ESG credentials of gold. Now, the responsible gold mining principles that Claire's mentioned are only part of what we're doing there. There is a pathway towards carbon neutrality that's been released by the World Gold Council, which shows that you can produce gold on a carbon neutral basis, and a pathway that might get us there by 2050. Hasn't yet been signed up by all of our member companies, but it's certainly something under active discussion. And then there's how gold contributes to the Sustainable Development Goals as well. Some more work that we've published there. So for those of you that are interested, when we recognize that this is really important and have devoted a lot of time and effort on this, and our website has lots of information, or Claire can send it to you if you're interested. Sorry, I interrupted. Helen.
Yeah, thank you, John. Another question from Morris. It's regarding the long-term prospects, more strategic considerations over 20, 30 or 40 years. For example, what may cryptocurrency trends do to the gold market? Many DB pension schemes are looking to de-risk their 30 to 40 year liabilities.
Absolutely, and look, a hugely important topic, the long-term returns to gold, and this is what we've tried to do, or tried to address, through the development of the valuation framework for gold, to take into consideration what are the long-term drivers of returns for gold. So Quorum not only helps you with where, if you put in your macroeconomic forecast, which of course you have to have if you're thinking of 30 to 40 years down the line. If you put in your macroeconomic forecasts, then the valuation tool will see what happens to supply and demand for gold on the basis of those inputs, but also what's happened in the past under similar circumstances, and generate an expected return for gold. And it depends what you put in, but you typically get a nominal 4 to 5% return, assuming inflation of sort of around the 1 to 2% level. So you're talking about a real return for gold under most economic input scenarios of around 3%. 3 to 4%, perhaps, something like that. So the valuation framework and the Quorum tool allows you to help on that. In terms of crypto, yes, we're getting a lot of questions about cryptocurrencies at the moment, and I'm not an expert, and I would say that we as an organization are not experts on cryptocurrencies, and we certainly wouldn't be making any recommendations for or against them, because that's not what we do. But looking at gold and comparing it to the behavior of cryptocurrencies is something we've spent some time on. We actually published another paper on that. I think it was last week, wasn't it, Claire? Yeah, I think it went out on Wednesday last week, because guess what? They're back in vogue. So we did quite a lot of these in 2017, quite a lot of work on this in 2017, and then with a crash in the market, it went quiet for a couple of years. And when we've been dusting these off over the past few months and updating them. And look, a lot of people describe Bitcoin as digital gold. Now, Bitcoin may have a lot of interesting characteristics, but one thing it's not is gold. It's not a tangible asset, obviously. Certainly, there's elements of cryptocurrencies which, by design, look a bit like gold. So the fact that they are limited in supply growth and finite in nature. I mean, I think the last Bitcoin will be mined in May 2140. Current growth rate's about 3% per annum. Growth rate in gold supply compared to the total stock of gold out there is about 1.6%. So yeah, there's certain elements of them which have been, intentionally created to make them look the same. There are also, of course, assets that are outside of the purview of governments. So central banks don't affect the supply of Bitcoin to the market, and governments don't really have any control over it. And same with gold. Gold cannot be printed away by in monetary policy actions. So there's some similarities there, and indeed, even on the demand side, there's elements of investment and speculation in the gold market. And if you look at the cryptocurrency market, I mean, yeah, some people say they use them, but look at most of it, it's mostly investment and primarily speculation. So some similarities there. But the return, and particularly the volatility characteristics of them, are very different. If you add gold to your portfolio over the last 10 years, pretty much everywhere we've looked, you've increased the risk-adjusted return of your portfolio. If you've added cryptocurrencies to your portfolio over the same period, you've increased your risk-adjusted return to your portfolios. But that increase in risk-adjusted return has come from the returns of cryptocurrencies. It's not come from the diversification. So your volatility goes up by adding cryptocurrencies. Your volatility goes down by adding gold. So gold's a genuine portfolio diversifier. Cryptocurrencies have been a source of return, no doubt about that, but with eye-popping volatility and drawdowns. So they're quite different in terms of the role that they play in the portfolio. Now, will we see people who might have bought gold buy cryptocurrencies? Yeah, I'm sure you will see at the margin some effect there. But I think also the fact that it's making more people conscious about the potential for inflation, the potential for government intervention in assets. So I suspect that we'll actually see people buy gold that perhaps wouldn't have done otherwise because of all the brouhaha regarding cryptocurrencies and Bitcoin in particular. So I don't see that as a long-term threat. And I think it actually could grow the space for assets which are not fiat denominated.
Thank you, John. One last question regarding the price of gold over the last 5 years. Our question is, are we at the top now?
Well, no, we're not. We're about 10% off the highs that we hit last year. That's the short answer to your question. Is the potential for more gains to come in gold? Certainly based on what the outputs from the valuation tool that I've referred to incessantly in my talk. If you feed in macroeconomic scenarios, and we source ours from Oxford Economics, but feel free to put your own in there, we're likely to see, based on the scenarios that they've developed, further strength in gold over the next year or two. Then depending on what happens to your economic views, there could be a period of consolidation and potentially correction coming through. It's worthwhile having a look there to see what might come through. But our view is to focus more on the long-term outlook for gold, and that comes back again to the 20, 30, 40-year view, which shows you that it should give you somewhere around 5% return over the long term, and that it will be an excellent portfolio diversifier and a source of liquidity during crises. So I think this, based on the work that we've done with the valuation framework, we think there is some more upside to come in the short term based on say, external forecasts, but focus more on the long term, I think, for the benefits that adding gold to your portfolio will bring.
Thank you very much, John. Right. I think if you've got any other questions, I'm sure John and Claire would be happy to answer them at a later stage. So I'd just like to really say thank you very much for being with us today. A big warm thank you to Claire and John for their time and for giving us a really good overview of the opportunities for investing in gold. And just finally to say thank you very much for joining us. I hope you found it very informative. I certainly have, and look forward to seeing you again in person in the not too near future. Thank you.
Thanks for
Thank you very much,
and thanks to everyone for joining.
Thank you. Bye-bye.
Thank you.
Bye.
Bye-bye.